Okay. Good morning, my dear future chartered accountants. Hope everybody is doing great. I hope all the festival seasons are over. Anyway, for CA students, there is no holiday, whether it is May or November. Can you please confirm first that my voice is audible and the PPT is visible? Okay. Yes. Good. Thank you. This is CA Chinmaya. We are going to be interacting with each other for next 3 days on the crash course Financial Management and Economics for Finance. Just to tell about myself in just 1 minute, I've cleared the exam in 2010. After that, I joined a equity research firm, and after 2015, I'm into full-time teaching. I do only two things every day in and day out. That is, one is trading, other is teaching. Those are the two, passion as well as my profession. In the foundation, I scored the All India 13th rank. In the intermediate, I scored third rank, and in the final level, I scored 39th rank. Yes, I'm a rank holder in all the three levels. The reason why I'm telling you this is not because I tell about myself, just to tell you that the method, the process, what we are going to follow is tried, tested, and verified, and you can also confidently follow it. That was the purpose. And one announcement to make, request from my side, 3 day sessions, as you know. It is scheduled at 7 o'clock to 1:30. Yes, we will do 7 to 1:30 as scheduled. But tomorrow and day after tomorrow, there is going to be a change in timings. It is going to be 10 to 1. Then maybe we'll take about 45 minutes break or maybe 1 hour break. And then till 5, maybe 2 to 5. Depending on that, we will take it. So from tomorrow onwards, for 2 days, I think we are in the last leg. The timing is going to be 10 to 5. So please make a note of it. It will not be early morning session. Tomorrow and day after tomorrow, the timing will be 10 to 5. We can finish a little bit here and there, but it will be around that timing. So if anybody joining late, please do inform them also. Okay. Let us look at your life quickly for a couple of minutes. How is your life when you started the CA classes, CA coaching, or CA career, and during exams? You know how your life is. The table has completely turned. And from your intermediate, foundation, intermediate, final level, where your position is, I'm sure you can imagine yourself. And CA syllabus, nobody can tell you. It is growing day by day. And during classes, I can see definitely lot of smiling faces, but somehow in the examination, the role will get reversed. Yes, uh, this is how a CS student prepares, keeping all the books open with a calculator, even for a law subjects. Of course, when you pass the exam, the world is at your feet. I would like to tell just this sentence, keep it in mind, till you clear CA. It is going to be hard, but it is going to be worth it. And everybody will feel the frustration, the irritation, the fear of missing out. You know, everybody is enjoying holidays where you're struggling with the classes. And let me tell you, these illustration frustrations are not just for you, it's for everybody else. You have to learn how to face it. Heated gold becomes ornament. Beaten copper is called as wire. Compressed carbon is called as diamond. Heated, beaten, and compressed person is called as a chartered accountant. There is no exception, there is no exemption. So I'm getting one of the messages. I'm 66 years old, took 20 years back, just passed CMA in first attempt. Very great to hear you that. I wish you all the best for the CA exams as well. Okay, so what point I'm trying to tell you is, remember this sentence till you pass examination. It is going to be hard, it is going to be frustrating, but remember this sentence, when you are struggling hard, it means you are becoming a better person day by day. Okay. I hope you have got the PDF. Have you got the material, my dear friends? I hope you got it. I shared with Girish earlier. You have got it, yes? Yeah. If anybody not got it, you can message me personally. My mobile number is there here also. Uh, yeah, mobile number is there in my PPT also. In every slide, my mobile number will be there. You can send me a WhatsApp page. I'll reply to that. Okay, so let us begin. We have about 10 chapters in financial management. We have 4 chapters in economics for finance. So, and marks allocation, 60/40. So we will also divide our timings accordingly that. And which chapter is more important? I hardly can say this chapter is more important. Almost all chapter comes for equal number of marks. Sometimes some chapter comes more, some other chapter comes less. So I really can't identify which chapter is less important or which chapter is most important. Up to 2019 November, I have updated. Then after that, couple of attempts have happened, so you can update this sheet for your reference. But anyway, this will not have much of impact because you can see that almost all chapters are important from exam point of view. I would say for CA exams there are two kinds of important chapters. One is important chapter, other is very important chapters. There is nothing called as unimportant. Everything is important. You can vary your level of coverage, but you can't really leave any topic in CA exams. CA exams is like, everybody will treat initially CA exam is like a Kabban Park or a Lal Bagh where you can easily take a walk. But later you realize it is not a normal regular park, it is a Jurassic Park. Easy to enter, difficult to exit. And during the course of the day, in our crash course, I will try to tell some joke in between, try to laugh at it. Anyway, I cannot get your reaction since it's online class, but try to laugh at it for your benefit. I know what would be your reaction. I have seen this earlier. This is old joke. This poor joke. Fine. But it is in interest of your health, your focus, that if you laugh a little bit in between, it's good for you. But I don't make an announcement, okay, that I'm telling you a joke. That is left for your choice. So 10 chapters on financial management and 4 chapters on economics for finance. So let us make a beginning. You should be aware of these basics. Profitability statement. I'll quickly run through it. I'm not sure whether this material has it. Let me just check it. Just give me 1 second. I'll just check whether your material has it. Okay, your material does not have specifically. Okay, maybe you can quickly note down, or you can take a photo of this and you can copy down later. But I'm sure you must be aware of this format. But anyway, it's my duty to quickly revise. Sales, profitability statement. This is not your schedule 3 format. This is for decision making purpose. This is an internal document which we use in financial management for decision making purpose. Sales minus variable cost is called as contribution, minus fixed cost is profit before interest and tax or EBIT. Less interest, you get profit before tax. Less tax, you get profit after tax. I can go one step further. Divide by number of equity shares, you get earnings per share called as EPS. Just keep this format in mind. Coming to balance sheet, again, don't expect a vertical form of balance sheet. We are not preparing Schedule 3 compliant. These are all for decision making purpose. So we will follow horizontal format. Even in examination, as far as financial management subject is concerned, you can follow the same format. So asset side, we will have fixed assets, current assets, and the other side we will have shareholders funds, long-term debt, current liabilities. Shareholders funds will be further divided typically into share capital and reserves and surplus. And the shareholders funds and long-term debt together is called as capital employed. A typical balance sheet format for the purpose of financial management, this subject. Okay. Chapter 1, let's quickly run through the theoretical aspects. One thing, keep it in mind, my dear friends. You have 8 subjects, right? You have 8 subjects. Now, can you tell me, out of 8 subjects, when you want to start a business, which law comes first? Is it like when you want to start a business, company law comes first because you should start a company? Or when you want to start a business, income tax law comes first, labor law comes first, GST law comes first, or your mercantile law? Can you tell me, when you want to start a business, which subject or which law comes first? Some people are telling company law, some people are telling labor law. Okay. What law which comes first is father-in-law. Don't take me, don't mistake me. I'm just trying to tell you on a lighter note. So only for conceptual purpose, don't take me wrong beyond that. That is, when you want to start a business, money comes first, right? Should I start a business or not? Finance, or I would say decision making. So throughout this subject, when you want to learn or when you want to calculate anything, ultimately you should be able to take a decision about the future. Decision about the future. See, what is accounts? Once the transactions happens, you account for it. Should the transaction happens or not, accounts will not tell you. Once you make an income, you have to pay income tax, right? And once you accounts are done, then you do audit whether accounts are correct or not. You see, all these things are post-mortem events. That means events will take place and subsequently you account for it, you audit for it. But financial management is the subject which is about decision making. Before thing happens, you're trying to analyze. So these are all about decision making purpose. The concept what you apply here in this subject can also be applied in your real life on a day-to-day basis as well as on long-term basis. And unlike accounts, audit, tax, financial management is not governed by any law. So we don't follow rules here, we follow principles. We follow concepts. That is why you should not interpret every question in the same way on the words you see. You have to interpret based on the context. So the words are not important. In some problems, I might have interpret like this. In some other problem, I may interpret something later. Like some problems I see cost of capital, and some problem I could use required rate of return. The term does not matter. The application, the concept to be applied. We are not governed by law. We are bound by principles, which you can apply in real life as well. You know, in English, there is a sentence. Behind every successful man, there is a woman. If you want more success, not more women. You have to put more hard work. I hope you understand the meaning of interpretation, right? So just by looking at the words, we should not come to a conclusion. We have to look at the context, situation, and then we should make a decision, especially in this subject. Let us continue. And again, in between, if you have any doubts, please make sure you get your doubts clarified at the earliest. Don't keep the doubts towards the end. These are all fast track crash courses. You will not have time. Later, you would have accumulated a lot of doubts. So as and when you get the doubts, you can get it clarified. Okay. So financial management is all about simple two things. That is efficient use of capital funds. That is how the money is put into use. That's all is the main objective. Two functions are there. One is procurement, other is application. So financial management is all about two simple aspects. Procurement, where to get the money from. Is it from equity shareholders where ownership share to be given? Or is it from debentures or loan where interest has to be paid? Or venture capitalist where again they are equity shareholders but they expect different kinds of returns. That is the objective, the functions of financial management is two things. Procurement, where to get the money. Application, where to put the money. So both are management aspects. If you want to invest somewhere, you don't have money, how to procure? It is covered in financial management. You have lot of money, but you have to invest. That is also financial management. So it's all about balancing. In fact, that is your balance sheet, right? Source of funds, application of funds. And application is capital budgeting, that is for long-term decision purpose, working capital management, that is management of day-to-day operations. And objectives of financial management is wealth maximization and not profit maximization. Meaning, profit maximization is short term. If a client comes, if a customer comes, give him something today, make maximum profit out of it. But objective of financial management is not to make a short term profit. We want to have that customer loyalty. We want to create brand and we want to create the customer base. That what do we call that brand building exercise is not a small or not a easy exercise. It will take a lot of time. See, now new age companies, Byju's, Zomato, they're all loss making companies, right? But still people do invest in those companies. You can see recently Zomato got listed. People are purchasing the shares. It's a loss making company. Why will they purchase? Because we believe that it is going to generate wealth in the long term. So when you take decisions also in your life, don't focus on the short term aspect, look at long term aspects. Typically today, you could have slept early in the morning, aram say like anybody else. but you are taking the effort of listening, and of course, it will be frustrating, irritating, but the benefit is there in the long run. We always say the effort is bitter, but the result is sweeter. You have to put that effort. So initially it may be loss making for some companies, but in the long term it should be creating wealth. So basically we look at long term asset generation and not short term profit. So objective of financial management is, or when the financial management, when the CEO, CFO, high level management want to take a decision, should I purchase the machinery or not? Should I acquire this company or not? Should I develop this brand or not? You should not look at what is the benefit today. You should look at what is the impact on shareholders' funds in the long term. That's what is wealth maximization. So wealth maximization is long term, profit maximization is short term. When you start a business also, let's suppose you start a practice, don't worry about getting the money from one time. Focus initially, he may not pay you or he may pay you less. That's okay. Make sure you acquire the client, in the sense you get the client for the long term. As the client grows, you will also grow. I hope you got the point. So wealth maximization is long term, profit is short term, and the definition of profit is also very uncertain, in the sense profit as per Income Tax Act, profit as per Companies Act, profit as per Payment of Bonus Act, operating profit, net profit, gross profit, so many terms. Profit, it is not clearly defined, whereas wealth maximization is very clear, it is shareholders funds. Decisions, not decisions, spelling mistake there, decisions. There are 3 decisions which you are going to learn as separate chapters going forward. Investment decisions, where to put the money. Financing decisions, where to take the money. Dividend decisions, should the money, the profit made by the company, be distributed to shareholders or not. We will discuss going forward about these 3 elements in the form of different chapters. And finance is called as the life blood of business. It is connected with other disciplines like productions, how many units to produce, how many units to keep it as inventory, how many units to purchase, should I have a discussion with my raw material supplier, how many credit days he will give me. Everything is connected. Personal management, so wages to be paid, bonus to be paid, how much money to be kept in cash. When I'm paying dividend, I should make sure that I don't have any obligation towards any bonus. So I have to pay bonus to my employees on Deepavali season. I should not pay dividend. Of course, if you have sufficient money, you can pay, but you have to think of all these aspects. Things are connected, is what I'm trying to tell. All finance, production, marketing, sales, all are connected with finance. This is just to give you the broad idea of basics of management. Of course, in detail, it is there in your material, in your study material also. Okay. One thing which is very basic is the time value of money. But time value of money is not there as a specific chapter in your syllabus, but you should know the time value of money concept. But time value of money, okay, I'll quickly discuss, but the application part of this will come in capital budgeting. So I'll quickly discuss about time value of money. I'll not spend too much of time, but what concept you should know at intermediate level. Time value of money. Basically, we tell rupee 1 today is not equal to rupee 1 tomorrow. That's what I mean. Rupee 1 today is not equal to rupee 1 tomorrow. Or we say today value we represent by P, that is present value, and later value is called as F, future value, And from present value to future value, we multiply 1 plus r to the power of n. Compound interest. That is basically future value is given as present value into 1 plus r to the power of n. But more than future value, finding the present value is more important, because we are making decisions today. Today I need to make decisions. So if you get some future cash flow, what is the value today? So since I'm going to make decision today about the future, it is always about finding the present value from the future. In future, you get so much of cash flows. If you start a business, you get so much. You take insurance policy, you take cash, or you do this education, you take this course, you get salary later. So in future, I get some cash flows. What is its value today? That's what finding the present value. So present value, I can write in two ways. One, future value divided by 1 plus r power n, just opposite. Or I can also do future value multiplied by discounting factor, or cash flow multiplied by discounting factor. And what is discounting factor? 1 by 1 plus r power n, the same factor. 1 by 1 plus r power n is called as discounting factor. So when you multiply a discounting factor, the future cash flow will become present value. To compute the present value, discounting factor is multiplied. But more importantly, what happens? There will not be one-time cash flow. There will be frequent cash flow. Year 1 also there will be cash flow. Year 2 also there will be cash flow. Year 3 also there will be cash flow. Means there will be frequent cash flows. Consistent cash flows. Like if you start a business, you get 1 lakh per annum, like that, consistent cash flows. All of these things I want to bring it to present value. Year 1 cash flow, year 2 cash flow, year 3 cash flow, all of them I want to bring it into present value. That is called as annuity factor. So year 1 cash flow, let's say F or A, whatever you can say, I'll just write it as F. So you have so many years future cash flows. The present value will be whatever the future cash flows multiplied by annuity factor. So what is the difference between discounting factor and annuity factor? First I'll tell you the common factor. Discounting factor converts future value into present value. Annuity factor converts future value into present value. But what is the difference? Discounting factor converts only one particular value, whereas annuity factor converts many values. So one for a particular year, we use discounting factor. For many years, as far as the amounts are equal, we use annuity factor. Both will convert future value into present value, because financial management is all about making decision today about future. Okay, so if you want, you can quickly note it down. I'll give you 2 minutes. If you have any doubt, please get it clarified. Examples on how to calculate with the numericals, I will take it up when we go to the capital budgeting chapter, investment decision. There I'll discuss with the numericals. This is just to give you the framework. Can we say annuity factor is equal to discounting for year 1? I think for 1 year you can say. First year annuity factor is equal to first year discounting factor. But like if I come to 2 years, first year discounting factor plus second year discounting factor is second year annuity factor. That means sum of discounting factor is called as annuity factor. Using discounting factor also you can calculate present value, but one by one you should do it. First year, second year, third year, like that. Then together, instead of one by one, together we can do with annuity factor. Okay. I hope it is done. Any doubts? Shall we go further? Yes. Okay. Good. Thank you. Let's move on. Okay. Types of financing. This is a theory chapter. I don't want to spend too much of time. I'll just quickly run through it. You can, theory is there in the material. You can read through it. So, types of financing, various sources of finance, long term financing, medium term financing, short term financing. Short term maybe less than 1 year, medium term around 1 to 3 years, long term more than 3 years, more than 5 years. So if you need the money for a long term purpose, for example, you are going to purchase machinery, and machinery will be used, building you are going to purchase. It's for long term purpose, not for short term purpose, right? Then source for that also, take it up with long term only. It may be from equity share capital, that is own money, or retained earnings, that is flowing back of profits. You make money, you save money, that is you make profit, you save profit and reinvest in the business. Internal. External means taking loans, long term loans, commercial papers. That is basically like a bond kind of thing, or with a fixed rate of interest. Debenture or a bonds, which are tradable instruments. Loans from financial institutions like IDBI, SBI, you take long term loan. Venture capital funding, very common these days, especially for unicorn like Byju's, Zomato's, Swiggy's, Ola, Uber, Facebook, where they took lot of venture capital funding, who invest your idea, who take risk and invest in your idea. Or there is also a concept of asset securitization, which means especially applicable for banks. They will convert the loan into a tradable security. And you can read through about it. A medium term loan, which is about 1 to 3 years, and short term loan, you get overdrafts from banks, leasing, you can get trade credits, you can request the supplier, give me more days credit, I'll purchase more units, things like that. So go through this thing. It's more of theory part. I don't want to spend too much of time. You can read. In any doubts you can get, you can always message me. Let's go to the next chapter, ratio analysis. We often tell, what is balance sheet? There is one common answer which student gives, which is perfectly understood but never applied. What is balance sheet? Balance sheet depicts financial position of an organization. Yes, balance sheet will show financial position of an organization. But if I give you balance sheet, what will you do? How will you see whether balance sheet is strong or not? What students will do? You look at the balance sheets, asset side, liability side, tallied or right balance sheet. That's what we students mindset, because tallying the balance sheet, is the happiness for CS students. For different people, different happiness. For CS students, tallying the balance sheet is called as ultimate happiness. That is not the way you analyze a balance sheet, right? I always say that there's a difference between knowledge and application. Knowledge is knowing that tomato is a fruit. You know, tomato is not a vegetable. Tomato is a fruit, scientifically. But application is don't put that in fruit salad. I'm preparing fruit salad. I know tomato is a fruit. I'll put it. That is not your application. So difference between knowledge and application. A good CA knows the Income Tax Act, every section, every case law. A good CA knows every income tax section perfectly. A great CA will know income tax officer. You know me? What I mean? Anyway, don't take it wrongly. Just for example purpose, I have given that. Anyway, so how to analyze a balance sheet is what we have, this ratio analysis. There are many things to understand about the balance sheet. This is one typical thing. Ratio analysis, connection between the various elements. And also, you can compare between two companies. One is Infosys, a very big company. Other is maybe some ABC Infotech, a small company. We can't compare them with profits. They are having crores of rupees. But we can compare them when I make it into the ratios. Okay. So broadly we have four types of ratio analysis. Maybe five, but broadly four. In detail, again, Metal has all the ratios. I'll quickly cover the important ones. We have liquidity ratio, or we'll say short-term solvency. Liquidity, I'll say short-term solvency. We have leverage ratios, profitability ratios, and turnover ratio. And also we can have one more, that is capital market ratio. Capital market ratios. Okay. Short-term solvency, I'll talk about two important ratios. One is, I'm not discussing all the ratios here. I'm only discussing what is the most important ones. In detailed ratio, you can go through it. Short-term solvency, we have liquidity ratio given by current assets by current liabilities. Basically, for 1 rupee current liability, how much current assets we have. Higher the ratio, the better it is. Then we have quick ratio. From the current assets, I take out inventory. That's also called as liquid assets, also called as quick assets, divided by current liabilities. It's also called as acid test ratio, because inventory will take some time to convert into cash. If I take inventory out, remaining how much current assets I have and compare it current liability, do I have sufficient amount to meet my current liability? That is short-term solvency. That is solvency, liquidity of the entity in the short-term position. Leverage ratio, basically whether you take how much loan or not. One important leverage ratio is debt equity ratio. Debt equity ratio is debt by equity. Equity means what? Not equity share capital. Equity means net worth. Share capital plus reserves and surplus. Debt means all kinds of debt. Debentures, loan from banks, term loan, everything. And we also say equity ratio or debt ratio, that will be debt by total capital, equity plus debt. But one more important ratio we say interest coverage ratio. What covers? Our profit should cover. That is EBIT divided by interest. EBIT, earnings before interest and tax divided by interest. How many times the interest is covered in our EBIT? Again, this also higher the better, but debt equity ratio lower is the better because higher debt represents higher risk. Profitability, gross profit ratio, net profit ratio, and all is there. I will talk about two important things. One is ROE, the other is ROCE. ROE, return on assets. ROE, return on equity. ROC, return on capital employed. So ROE is net profits divided by equity. Equity means your net worth into 100. How much is the profit as far as the equity shareholder is concerned? ROCE is EBIT divided by capital employed. Capital employed is equity plus debt into 100. This before tax. If I multiply it by 1 minus t, I'll get after tax. Remember this. Whenever I multiply it by 1 minus t, I get after tax. And turnover ratio, we have assets turnover ratio, data turnover ratio, inventory turnover ratio, and so on. Turnover means sales. So numerator I'll take sales. Denominator I'll take respective assets. I'll just say assets. It may be fixed assets, it may be debtors, it may be in creditors, it may be debtor, creditor, it may be inventory. But for debtors we take credit sales. For inventory, we take cost of sales or cost of goods sold. But format is this, sales by assets. Maybe fixed assets, maybe current assets, anything. That is turnover ratio. Numerator is turnover, denominator is respective variable. Capital market ratio, we have two important things. One is dividend yield. I'll just write it here. We have dividend yield. That is dividend per share by market per share into 100. MPS, market price per share. DPS, dividend per share. So when the shareholders invest, how to become a shareholder of a company? You purchase the share. So your investment is MPS, market price per share. And what you get as the return? DPS. So dividend is the income and MPS is the investment. That DPS by MPS is called as dividend yield. And one more important ratio is PE ratio, price earning ratio. Formula is given by MPS divided by EPS. No, don't multiply it by 100. It's a ratio absolutely. What is this P ratio basically means? It's like comparing rental income of a property with value of house property. Suppose rental income is 10 lakhs and value of the property is 80 lakhs. That means this property is worth 8 times its rental income. Property value 8 lakhs, 10 lakh is the earnings. So this property value, can I say 8 times its earnings? 80 lakh is 8 times of 10 lakh. That's what this. If company makes profits of 10 lakh and company is worth 80 lakh or let's say 10 per share and 80 per share, then we say that company is 8 times of its earning. If company makes 1 rupee profit, its value, its wealth, it will increase by 8 rupees. The ratio between earnings of a company and value of a company is given by P ratio. This has got lot of significance in real life, especially in stock market. You can figure it out later. This is just a broad overview of the ratio analysis. there's one interesting element is also called as DuPont chart, but I'll just quickly give you the idea. If I say ROE, how it is calculated? That is, I told you, it's net profit by equity. What shareholders invest is equity, and what they get is net profit. Net profit by equity. And what you can do, you will actually, the people divide this into two parts. That is the things, this is like return on assets. A return ratio, they will keep it as one part. Asset turnover, they'll keep it as one part. That is, how you converted your profits and into your investments. In the sense, if I just keep it as this in a simple form, ROE or ROI, like return or profits, I'll say, profits divided by assets or investment. If I bring it into two parts, I'll make like this: profit divided by sales into sales divided by investment or asset, whatever it is. Now you please see, sales will get cancelled, so ultimately you get the same thing. But you understand, profit by sales is profit ratio, profit margin. Sales by investment is turnover ratio. So this, you can also say your ROE, profit for the shareholder, is component of two things. One, how you convert your asset into sales, that is how is your turnover ratio, and how much profitability you make. So both of them are going to be important. Anyway, we look at many things before we invest in a company, before company gives loan, before bank gives company loan. But these are the main ratios to be looked into. As far as the exam is concerned, you will get two kind of questions. One, they will give the parameters, like they will give you current assets, they will give you equity, you should calculate ratio. And more challengingly, one more variety of question will come, they will give ratios and you have to calculate the variables. We will do both the kind of problems. Okay, I hope you are kind of understood overall view about the ratio analysis. In detail, I have given. You can go to the material. And one thing you can keep it in mind, all the ratios are higher the better. All the ratios are higher the better. The only ratio which is lower the better is debt equity ratio. And you have some inventory days, debtor days, that is lower the ratio. Apart from that, everything else is higher the ratio better. So debt equity ratio, lower better, lower the better, lower is good, lower debt is good. Apart from that, everything higher the ratio is a better one. I know that I have gone fast in the ratio analysis, and the purpose of this crash course is to revise. If you're coming for the first time, you will not be able to understand. So if you have read it, understood to an extent, this is a perfect revision for you. Don't expect these sessions to cover the topics in detail. So whatever the overall view, I'm trying to give you. Okay. Any questions from your side before we take up problems? Okay. I believe no particular questions. We can go further. Okay. Let's take up problems. and all the questions, at least most of the question, I ensure it is from previous exam questions. So you know that these questions are exam level questions. I hope you get some confidence. There's one thing I would like you to follow it also, because how much ever practice you do, examination question is always the high standard. It is like how much ever IPL you play, international level is always international level, right? You understand? Many players perform super in gully cricket, IPL. International matches, they flop. Students also have seen exactly the same thing. When they do it in the class, they do perfect. Do in mock exam, do perfect. Somehow in the examination, no performance. So what you should do? Try solving as many exam questions as possible. People ask me, sir, which book should I read? Which academy notes is good? Should I read study material? How many RTPs, MTPs I should read? I have one simple suggestion for you. You keep all these things in one hand. That is RTP, MTP, study material and whatnot. And the previous exam question paper is another hand. I will still consider the previous question paper as more important. So I don't know how many questions you solve, how many books you refer. One thing which is a must is previous year question paper, be it old syllabus, be it new syllabus. FM is common everywhere. So please do read, solve previous year question papers. If possible, do for all the subjects. Anyway, so I've taken the questions from previous year question papers only so that you get understand exam level questions. Let's come to this problem. Hope you got the material question. Following information relates to RM Company Limited, total assets employed, direct cost, other operating cost, goods are sold to the customer at 150% of direct cost, 50% of the asset being financed by borrowed capital at interest of 8% per annum, tax rate 30%. You're required to calculate net profit margin, return on total assets, asset turnover, return on owner's equity. Okay. So first thing is net profit margin. Net profit margin formula, net profit by sales. Where is sales? Oh, so sales are not given. But what information is given? Goods are sold to customer at 150% of direct cost. Okay, let's do one thing. In these kind of things, always have two things. One is a capital structure, other is profitability statement or income statement, you can say. We are going to follow this in our cost of capital structure theory chapter also. So one I will do income statement, other is capital structure, or you can say like balance sheet, capital structure. Okay. What information they have given? Total asset employed 10 lakh, total assets, total capital we can say 10 lakh. Whatever they win, I'm writing it. Income statement. What is the format of income statement? I need sales minus direct cost or variable cost, which will give me gross profit. Or then fixed cost. 1 second. Okay. So gross profits. Other operating cost or fixed cost. Other operating expenses. I'll say operating cost, which will give me profit before tax or EBIT. Tax rate is also there. This will give me EBIT. Okay. Let's calculate what information we have. Direct cost 5,50,000 they have given. So direct cost 5,50,000. And what about sales? Information is there. 150% of direct cost. So 5,50,000 is the direct cost of that 150%. So into 150%. Direct cost 150%. That is 8,25,000. So minus 5,50,000. 2,75,000 is gross profits. Operating cost they have given 90,000. That is 1,85,000 is EBIT less interest. Let's calculate how much is that less interest. That will give me EBT less tax. That will give me profit after tax or net profit. Profit after tax. Okay. So interest, we don't know. They have given 50% of the asset is by borrowed capital. So whatever the assets you have, 50% is borrowed capital, means 50% is loan, and balance 50% own funds. That is, you can say equity, own funds, equity. So 50% of 10 lakh is 5 lakh, and own funds also 5 lakh. And on loan, you have to pay interest. How much interest? 8%. So interest 8%. So 8% of 5 lakh, that is 40,000, I think. 5 lakh into 8%. So 40,000. Give me 1 minute. Give me 1 minute. The system is slightly slow. Okay, so 1,85,000 minus interest 40,000. 1,45,000 is EBT minus tax. Tax rate is given 30%. So 1,45,000, 30%, 43,500. So 1,01,500 is profit after tax. Okay, let's ask whatever the ratios they're asking one by one. Let's calculate. First one, net profit margin. Net profit margin, that is PAT divided by sales into 100. PAT we calculated 1,01,500. Sales 8,25,000 into 100. 12.303, 12.30 percentage. Next, return on assets. Return on assets, ROA. Return means profit. So profit after tax divided by total assets. Total profit after tax 1,01,500 by assets 10 lakhs into 100. So whenever is percentage, we will express in into 100. 1,01,500 divided by 10 lakh, 10.15%. Assets turnover, sales by assets, sales 8,25,000 divided by assets, which is 10 lakh. No, into 100, just as it is 0.825, I think. Next, return on owner's equity. That is ROE, return on owner equity, ROE. Return, that is PAT, divided by equity, or I can say own funds, into hundreds. PAT is 1,01,500 divided by own funds 5 lakh into 100. .20. Okay, let's move on. Let's do reverse problem now, where they will give you ratios and we will have to calculate the numbers. So we can come to next question. The accountant of Moon Limited has reported the following data: gross profit margin, total assets turnover, net worth total assets, current ratio, liquid assets to current liability, credit sales to total sales, average collection periods, assume 360 days in a year. You are required to complete the following: balance sheet of Moon Limited, net worth, current liability, total liability, fixed assets, stock, debtors, cash, total assets. Uh, there is one popular question among the students in this, that is, sir, how to start, starting trouble, and how to move further. Okay, I'll always have one standard thing, not only for this question, even in your life you can apply. When you don't know what to do, when you don't know what to do what you can with available resources. Do what you can. And here, in this problem, what information we have? We have all the ratios, but only one number is available, that is gross profit. All other are ratios. That is a hint. You have to start with gross profit. And one more thing, keep this in mind: thumb rule, shortcut, whatever you can call it. Always look for information related to sales. Turnover is a very key data, whether do it in real life business or in examination question. Look always for sales. If you think big lock and you want a key to open it, that is sales. If the question is a big lock, the solution is key sales. Key data is sales. So when you have this information, if you get the sales, lot of other things can be calculated. So we have gross profit and gross profit margin. Let's make use of that information. That's what we have now. Just give me 1 minute. Okay. Let's start with gross profit margin formula. Gross profit equals gross profit margin means GP ratio. GP by sales into hundreds. Gross profit margin they have given 20%. GP gross profit 60,000. So I can compute sales. That's why I told you, always look for the key data sales. Once you get the sales, many other things can be calculated. So sales equals 60,000 by 20 into 100, that is 3 lakh. Okay, next. So now we have sales. So what is the advantage of sales data? We can connect everything related to sales. One by one, see total asset turnover ratio. The total asset turnover ratio, sales we know. We can calculate total assets. That's right, total asset turnover ratio. Total assets turnover ratio. Any turnover ratio I told you, numerator will be sales. For inventory, it will be cost of sales divided by respective assets. In this case, assets. This ratio is given as 0.3 is to 1. 0.3 is to 1 means 0.3 by 1. Sales we know it is 3 lakh. So we can calculate assets. So assets is cross multiply 3 lakh divided by 0.3, which is 10 lakh. Okay, net worth to total assets. Now we have total assets. We can calculate net worth. You see, once you calculate one thing, the things will get solved automatically like a puzzle. It is just the starting point you have to cover with confidence. Okay, so next they have given net worth to total assets. Net worth to total assets. This question only has it, I mean, this name only has it. Net worth divided by total assets. Ratio is given as 0.9 is to 1. So 0.9 divided by 1. Net worth we don't know. Total asset we just calculated 10 lakh. Total asset we know 10 lakh. So net worth 10 lakh into 0.9, that is 9 lakh. Okay, what else we have? Current ratio. Current ratio, we don't know current assets, we don't know current liabilities. Okay, for the time being, I'll take it out. Current ratio, liquid ratio. Okay, what? Okay, now first you write down till here, then I'll tell you how to think. Okay, next. Next we have current ratio. Current ratio means I need current assets also, current liability also. Both of them are not having. I'll move further. Liquid assets to current liability. I don't know liquid assets. I don't know current liability. I cannot use this also. Credit sales to total sales. This I can calculate because I know the total sales. I'll be able to calculate the credit sales. So let's do that. Credit sales to total sales. Credit sales to total sales. Same ratio, that is credit sales divided by total sales. This is given ratio as 0.8 is to 1. So 0.8 divided by 1. Credit sales we don't know. Total sales we know. We have calculated. You see one sales data, how many things we could calculate. Sales is the key data. Sales is 3 lakh. So credit sales 3 lakh into 0.8. 2,40,000. Okay. Next information what we have is on average collection period. So we can connect debtors here 60 days. Okay. I'll take it to next slide. Have you done till here? Shall I go to the next one? Yes, thank you. Okay. So average collection period 60 days. Average collection period, let me write the formula. ACP, average collection period. They said also assume 360 days in a year. So debtors divided by credit sales into 360 given as 60 days. Debtors we have to calculate. Credit sales we just calculated 2,40,000 into 360. So debtors is 2,40,000 into 60 by 360. I think 40,000. Okay, now we have calculated so much. Now to move further, you know what do I do? Let's fill up the balance sheet to the extent we can. When you don't know what to do what you can. So let's go to the question. You rewrite the thing. Let's save time some time. Let's write it here itself. What and all we calculated? What I can calculate? I think total assets we have calculated 10 lakhs. Total assets 10 lakhs means total liability also 10 lakhs. Then we have calculated net worth 9 lakh. And we have calculated sales over debtor 40,000. Okay, we calculated debtors 40,000. Fine. Now here, can you tell me what I can calculate here? One thing is easily evident. We can calculate as a balancing figure. Current liabilities, absolutely. As a balancing figure, 10 lakh minus 9 lakh, 1 lakh. So you can show the calculation somewhere. Current liabilities, 10 lakh minus 1 lakh. Total liability minus net worth. So current liabilities, 10 lakh minus 9 lakh. 1 lakh. Balancing figure. So current liability is 1 lakh. Okay, let's go back to the question now. Current liability we know. Current ratio is connected with current liability. Liquid assets is connected with current liability. So let's make use of that. Current ratio, that is current assets by current liability. 1.5 is to 1. 1.5 by 1. Current assets we don't know. Current liability we just calculated now 1 lakh. So current assets 1 lakh into 1.5, that is 1,50,000. Then they have given liquid assets to current liability. Liquid assets to current liability is given as 1 is to 1. That is 1 by 1. So liquid assets means current assets minus inventory by current liability is given as 1 is to 1. So 1 by 1. Current assets we know 1,50,000 minus inventory. My current liability 1 lakh. So you can cross multiply. So inventory equals 1,50,000 minus 1 lakh. It is 50,000. So 50,000 inventory. And total of this stock debtors cash current assets should be 1 lakh. So 1,50,000. Current assets should be 1,50,000. So you can calculate cash as balancing figure. 1,50,000 minus 50 minus 40, I think 60,000 you get. And fixed assets is also a balancing figure. Total 110 lakh, 1,50,000. So fixed assets should be 8,50,000. Okay. So let me know if you have any doubts. Or any other doubt in the ratio chapter, you can ask. Okay, so no questions coming. So let's move forwards. Okay. So next what we have is cost of capital chapter. So now we are moving to the source of finance. Source of finance, we have three chapters: cost of capital, leverage, capital structure theories. First, let's take cost of capital. So when you think of a business or a company, what they typically do, they get the money and they invest. Source and application. Now, when you take a decision regarding where to invest, how do you make a decision? You make a decision wherever I get the highest profit. Now, one project gives you, let's say, 8%, other project gives you 6%. Now, which one will you select? Obviously, I'll select 8%. But imagine if you're taking a loan and your loan is 10% interest. Now, will you accept the business for 8%? You have to make sure at least 8% you generate. Otherwise, your business will be loss making, correct? So, more than whichever is more profitable, you have to ensure at least your rate of interest is covered. Then only you can make profit. That is what we want to understand about cost of capital. So when you want to make a decision in the investing later, you have to have a required rate of return, cutoff rate. And how do you determine that? We have this chapter, which is cost of capital. Okay, what is one typical source of finance? One typical source of finance is loan. For the company, you're taking a loan. Okay, so if I take a company or business, one source, what comes in is a loan, you take loan, and what you pay is interest. So in a way, if other things remaining constant, one of the cost of capital is rate of interest. So cost of capital is rate of interest. But you have to consider few more other aspects as well. I'll come to it. You have to consider tax aspect. You have to consider issue expenses, flotation cost. You have to consider redemption price. I'll come to all of those things. First, I'll discuss the broad aspects. Okay, so company takes loan, pays interest, cost of capital is rate of interest. Now, company gets equity, own funds, equity. And what company pays? Can you tell me? What does company pay? You get loan, you pay interest. If it is preference share, you pay preference share dividend. For equity, you pay dividends. Yes, you pay dividends. There is nothing called as dividend interest, okay? Dividend, that's all. There's no dividend interest, dividend. But one thing, dividend is one of them. But dividend is not a compulsory thing. Okay. Now, here is one interesting aspect you have to understand. Yes, dividend is one of them. Dividend is one of them. This is lenders. This is company. This is ESH, equity shareholders. And this is company. Okay. Now, one interesting, important topic you have to understand. I'll give you one minute example. You are living in a city like Bangalore. Now tell me, which is more costlier? Living in own house or living in rented house? Which is more costlier? Living in own house, living in rented house? Let's say there is no loan in your house property. It is in your name only. You don't have to share, no legal obligations. Which is more costly? Many people think living in a rented house is costly. Okay, now So living in own house is cheaper. Okay, now you tell me, you're having a house in MG Road. Now, is it better to rent a property in MG Road and live somewhere nearby? Or is it better to live in the house in MG Road? You're getting my point? Which is better? In MG Road, if your house, if you live in your own house, it is not good. You lose interest income. You're getting my point? Even own money also has a cost. How? Even own house has a cost. Opportunity cost. What opportunity cost? In the own house, you could have earned rental income. In the own house, you could have earned rental income. Opportunity costs. Okay, so from the point of view of company regarding the cost of capital chapter, in case of loan, interest is a fixed amount which we know. But in case of equity shareholders, equity, the dividend is not fixed. It's not a fixed amount. Dividend amount, equity dividend is not a fixed amount. Therefore, we calculate from the point of view of equity shareholder what he expects. So the shareholder's expectation is company's cost. Shareholders expectation is company's cost. Shareholders expectation is company's cost. So regarding cost of equity, we have different theories. We have different formulas. Okay. Basic concept I just want to tell you. I told you that. Now I'll come to the formula part of it. I'll come to the formula, then we'll do the problem, one overall problem. Okay. Okay. Cost of capital. What is the meaning of cost of capital? Cost of raising every rupee of capital. Every rupee of capital, own money has a cost in terms of expectation of the shareholders. Borrowed money has cost, interest. So I'll come to this overall formula. We have cost of debts. We have two kinds, redeemable, irredeemable. Now, redeemable debts. We have one formula. Redeemable debt formula is given by interest into, okay, let me write the formula. Then let me explain the formula with logic. Then I'll show the formula. Redeemable debentures, redeemable debt. Okay. Now, basic formula you remember, numerator will be interest or whatever the expense. Denominator is the loan. Simple formula. Numerator is the interest that you have to pay. Denominator is the loan company has taken. Denominator is capital. Numerator is the cost. Interest. Cost of capital, interest on loan. But now redeemable debt, we will have to do some changes. What is that change? Now interest, I will take after tax, whether income or expense. If I want after tax, 1 minus t will be multiplied. Correct? Interest into 1 minus t plus. Now, in case of redeemable debt, you're going to pay one more extra payment. What is that? today what you receive and after redemption what you pay will not be same. For example, today you issue debentures, you will receive 1 lakh. After 5 years, you will repay 1,20,000. How much you're receiving? 1 lakh. How much you're redeeming? 1,20,000. How much extra you're paying? 20,000. Now that is also your expense. Interest is your expense. In addition to that, the payment on the additional amount, the difference between the amount you receive and the amount you pay is also going to be your expense. And that's what we say the formula net proceeds or redemption value RV minus net proceeds. Redemption value 1,20,000. Example I'm giving you. Net proceeds today I received 1 lakh. So 20,000 I'm paying extra. That is my expense. But interest I pay every year. This 20,000 will come only 1 year, only one time. But I want every year. So what should I do? I will divide by n. Divide by number of years. So interest expense which comes one time, interest into 1 minus t after tax, redeemable value minus net proceeds divided by n, redeemable value minus net proceeds. This is like a depreciation formula. What is depreciation formula? Original cost minus scrap value divided by useful life. That's what I'm doing. Redeemable value minus net proceeds is the extra amount you're going to pay. But only one time. Divide by n like an amortization, depreciation. RV, redeemable value. NP, net proceeds. And denominator, I will take average loan. Because every year now, the loan amount outstanding will change. So I will take year denominator, average loan, redeemable value plus net proceeds divided by 2. And remember, this net proceeds should be after flotation cost. That is issue price minus flotation cost. Like brokerage expenses, stamp duty, underwriting charges, SEBI registration, filing charges, consultancy fees. Lot of flotation cost will be there when you raise the money in public or capital market. So net proceeds is issue price minus flotation cost, net proceeds. Whatever the amount we received minus amount we paid. Net amount is what? Net proceeds. So basic structure, hope you understood. That is interest into 1 minus t plus RV minus NP divided by n. Now remember 1 minus t, I am not multiplying for the second part. Because I am assuming the second part is not allowed for tax purpose. That's what institute also assume mostly. But if you assume otherwise, then there also you can do into 1 minus t divided by RV plus NP divided by 2. If it is redeemable, irredeemable, the n and all will not be there. Simple formula. Interest into 1 minus t, only that part will be there. The second part will not be there. Because redeemable value we don't know. Irredeemable. Redeemable value we don't know. Net proceeds, redeemable value plus net proceeds divided by 2 will not come. Simply net proceeds. Preference shares, same formula will come. Only thing what it will be there. Instead of interest, preference share dividend will come. Because preference shares, we pay preference share dividend, and more importantly, this 1 minus t will not come. So preference shares, same as debt, except no 1 minus t. That 1 minus t factor will not come because preference share dividend is not an expense. It is not allowed for tax purposes as an expense. That 1 minus t what I am doing will not come in preference share dividend. Apart from that, cost of debt, cost of preference share, both are same. I'll come to some product, will come to it later, or I'll tell you now itself. Cost of equity, I'll tell it later. Now we have company which has cost of debt also, cost of preferences also, cost of equity also. Now company will have all the three. We have to mix everything and then they invest. So mixing everything means average. And it's not going to be a simple average because the amount of debt will be different, amount of preferential will be different, amount of equity will be different, and that is why it is going to be weighted average, the cost multiplied by respective weights. Weights may be based on book value, weights may be based on market value. But anyway, both answers will be different. In the exam, they'll give you which one to use. If they're not given, you can use anything. Cost of equity, I'll have to explain. And there's also one more concept, marginal cost of capital, nothing different. You're already having one finance loan or you're taking extra capital. So for taking extra capital, what is the cost? It's called as marginal cost of capital. Anyway, those things are not very important. This cost of debt formula is important. Cost of preference share is important. Cost of equity is important. And mix, overall cost of or weighted average cost of capital is relevant. Before I go to cost of equity, can you tell me, do you have any doubts with respect to cost of debt and cost of preference share? Understand with logic. Any doubts? Okay. Now we'll go to cost of equity. Cost of equity, as I told you, this is subjective because it has opportunity cost. Subjective. It cannot be calculated particularly, specifically. So we have two methods. One is dividend growth model. The other is a CAPM model, cost capital asset pricing model. Dividend growth model. Now, one of the things you only told me, what does equity shareholders expect is dividend. So dividend is what shareholder expecting D1. Dividend expected at the end of year 1, D1. Dividend expected at the end of year 1. Divided by P0, market price today. So D1 divided by P0. That is P0 is the market price. That is market price is like a company is receiving money so much. Or if you think from the equity shareholders point of view, if he has to become equity shareholder, he has to pay that much money to become the shareholder. See, if I want to become an Infosys shareholder, I have to buy the Infosys share today. So today's share price denominator is like investment for equity shareholder, and what he gets is dividend. But just getting dividend not sufficient. Every year he wants the growth also. Therefore, D1 divided by P0, dividend expected at the end of year 1, divided by P0, net proceeds, market price today, plus growth rate. So information is there in the problem regarding dividends. We'll make use of dividends. Other most important one, CAPM model, capital asset pricing model. Formula is given by RF plus B into RM minus RF. RF is risk-free rate, RM is market rate, RF is risk-free rate, B for beta, and B stands for beta, beta stands for risk. Okay, now you tell me this. I invest in fixed deposits, FD. I invest in equity shares. I invest both case 1 lakh. Can you tell me where I expect higher return? I invest in fixed deposit. I invest in equity shares, stock market. Where I expect higher return? Definitely I expect higher return in equity shares. Why? Why should I expect higher return in equity shares? In fact, fixed deposit is safe, no? Why should I expect higher return in equity share? Because it carries risk. Absolutely right. Because it has risk, we expect Whether we get or not is separate. These are all expectations. So when we have a higher risk, we expect a higher return. Now you tell me, suppose in the equity, different companies are there. Let's say we'll take Infosys and we'll take Yes Bank. I'm sure you would have heard of so many things happened in Yes Bank, almost closed about few years back, about few months back. Now tell me, Infosys is riskier or Yes Bank is riskier? Which is high risk? Infosys is riskier. Okay, come on. Okay, Yes Bank is riskier. Yes Bank is almost in the verge of closing down. It's almost going to be liquidated. I mean, a lot of problems. Okay, I mean, if you're investing in Yes Bank or you invest in Vodafone Idea versus Infosys. Vodafone Idea is almost getting closed down. So there also, when you have a higher risk, you expect a higher return. So how do you reflect this as the higher risk? We calculate beta. Sir, how to calculate beta? You don't worry now. It has mathematical formulas. You will learn in CA final level SFM portfolio management chapter. You learn the formula there, how to calculate, how this formula is derived and so on. But basically remember, beta B reflects risk. So whenever you invest in any stock, especially in equity, it has two components. One is risk free, other is return for risk, called as risk premium. So RF is the return for the risk free, RF risk free, but additional risk you take, you require additional return. How much return? That is the second part, RM minus RF into beta. RM minus RF is also called as market risk premium. Over and above risk free is called as risk premium. So RM minus RF, sometimes they'll call it as market risk premium into beta represent risk that will be given the problem. Higher the beta, higher the expected return. And hence CAPM model, capital asset pricing model. In the exam, they'll give you RF, they'll give you RM, market return, risk-free rate. Sometimes they'll give you government yield, government bond yield, treasury yield. All are risk-free rate. Market return, index return, Sensex return, Nifty return or RM. Beta, they'll give you. Or sometimes, instead of telling you RM separately, RF separately, they'll tell you RM minus RF. That is called as market premium, which represent the second part. Market premium means RM minus RF directly given. You simply multiply by beta, then do RF, you get the CAPM return. So practically we use this one more, CAPM model, but in examination, if information is there regarding dividend, we use this. If information is there regarding CAPM model, we use this. And then we take a weighted average of all of these things, the weights multiplied by respective cost, we get the WACC, weighted average cost of capital, which may be based on book value weights or market value weights, depends on information given in the problem. If nothing is given, you can choose any of them. There's also one more thing, marginal cost of capital, which is the cost of capital, average cost of capital only for the additional capital, not for the existing one, only for the new capital, you calculate the cost. That's called as marginal cost of capital, cost of raising additional source of finance. Theory only, problem is same. Okay, so this is the summary of cost of capital chapter. Any doubts you have before we take up to the problems? I know you will have break. I know you require break. We will take break. Don't worry. But before that, if you have any doubts, let me clarify that. Marginal cost of capital, no new formula. Marginal cost is cost of raising additional finance. Existing, you have 5-10 lakh capital. You are going for additional 3 lakh capital. So only for the 3 lakh. What is the source? What is its cost of capital? Take an average. For the new source, you take a average cost of capital called as marginal cost of capital. So no new separate thing there. It's just a theory. Cost of raising additional finance. Okay. So there's no other questions. So let us take a break for breakfast. Ideally, I was supposed to give the break in between also, but I've taken the continuous classes, so let's take a slightly longer break. Let's meet at 9:45, 9 o'clock now almost. So I think 45 minutes should be good enough, and revise these concepts also, and then we'll do a problem on this. Let's meet at 9:45. Okay, so let's take a break for breakfast. Let's meet at 9:45.